Dell Technologies shares surged as much as 38% Friday morning to an all-time high, following an upbeat annual forecast from the technology equipment maker. It is benefiting from the artificial intelligence boom. Orders for Dell's AI-optimized servers jumped 40% sequentially in the fourth quarter, according to the company's chief operating officer, who also noted more customers were demanding PCs and servers with AI capabilities. The huge pop in its stock provides further evidence that rising AI adoption is driving gains across enterprise technology vendors and adds to the frenzy on Wall Street following Nvidia's stunning rally. At least 9 brokerages raised their price targets on Dell's stock, including analysts at Bernstein, who said the company's AI business showed strong progress. The recent upside in the business comes after Dell struggled over the last 2 years, as worldwide computer sales sharply declined. Dell said annual revenue dropped for the first time since Dell relisted in 2018, though sales fell less than predicted in the fourth quarter.
DHL says there is little sign yet of a global trade rebound. On Wednesday, the German delivery giant forecast operating profit to come in above pre-pandemic levels. It expects pre-tax earnings of up to $7.2 billion for this year, at best matching analyst estimates. DHL said it didn't foresee any broad economic upturn in the first half of the year, with some markets even set to get worse. Chief Executive Tobias Myers said 2023 had been characterized by a weak global economy and, above all, weak global trade. He said geopolitical tensions would remain a drag this year, with demand set to be volatile. However, the firm expects global economic momentum to start building again in the second half. DHL reported pre-tax earnings of around $6.8 billion for 2023, well down on the previous year and short of analyst estimates. The company said it would step up a share buyback program to €4 billion, or over $4.3 billion. German state-owned bank KfW recently sold some of its stake in the firm as part of a broader privatization push, but it remains DHL's biggest single shareholder for now.
Wall Street's main indexes dropped sharply on Tuesday, with Apple and chip stocks weighing heavily on the Nasdaq. The Dow and S&P 500 each shed 1%, and the Nasdaq plunged nearly 1.7%. Apple shares shed nearly 3% after a research report showed iPhone sales in China fell 24% year over year in the first 6 weeks of 2024. The drop comes amid increasing popularity for smartphones made by Chinese rival Huawei. But shares of Apple are still a good bet, says Jimmy Lee, CEO of the Wealth Consulting Group.
It's a great company, right, that has incredible market share for what they do. And right now, it's underperformed the NASDAQ dramatically, and even the S&P 500 over the last 12 months. By over half, I believe, of the S&P 500. And so if you're looking to get into a name like that, and if you like the company from a value perspective, you can see a little bit of value there, right? Versus maybe the ones that are trading at higher valuations and near all-time highs.
Speaking of those stocks with high valuations, the chip sector was battered after Bloomberg News reported that Advanced Micro Devices hit a roadblock in its efforts to sell an artificial intelligence chip tailored for the Chinese market as Washington cracks down on tech exports to Beijing. The Philadelphia Semiconductor Index shed 2%. On the upside, Target shares rallied 12% after the retailer forecast annual comparable sales largely above estimates, betting on same-day services, product launches, and a new membership program to boost spending. Investors now turn their attention to Federal Reserve Chair Jerome Powell, who testifies before lawmakers on Wednesday and Thursday, and the crucial non-farm payrolls report due out Friday for more clues about interest rate policy.
Target is aiming for a better year in 2024. On Tuesday, the retailer said the holiday season was better than expected. Earnings for the quarter came in at almost $3 per share, more than 50% up on this time last year and easily ahead of analyst forecasts. The company said Black Friday and Cyber Monday events drove selling. It now bets that annual sales will come in better than Wall Street expects. Shares in the firm jumped 12% after that bullish outlook. Target now plans to launch a paid membership scheme starting next month, which will offer shoppers unlimited same-day delivery. It's also planning new and improved stores. Over the next decade, it expects to open more than 300 U.S. outlets and remodel most of its 2,000 existing ones. That puts it in line with other big retailers, including Walmart, Sam's Club, and Bloomingdale's, which are all planning to add new locations. It's a big change in strategy following years of branch closures while under pressure from online retailers. Industry experts say consumers do continue to visit stores even if only to pick up orders. In its most recent results, Walmart said order pickup and delivery offerings helped drive a 4% rise in traffic to its stores.
JD.com saw revenues beat estimates in the fourth quarter. On Wednesday, the Chinese online retailer reported revenue of $42.52 billion, just ahead of analyst projections. Aggressive price cuts helped revive demand from consumers dealing with an uncertain economy. China's economic growth has been shaky recently, while high youth unemployment and lower wages for office workers have led to consumers tightening their purse strings. That's driven retailers like JD.com to employ heavy discounts to support sales. Some analysts believe the company's popularity among cost-conscious buyers has grown over the quarter. JD.com also announced it would upsize its share repurchase program on Wednesday. It said it will buy up to $3 billion worth of its shares over the next 36 months. Investors liked what they heard as JD.com shares jumped 12% in US pre-market trading.